Greetings traders, and welcome back to another survival guide. In the trading world, most of us are already aware that we can go long or we can go short. We can buy or we can sell. But the concept behind that, even though it's very simple, gets a lot more difficult in knowing when to do either. As day traders, we're usually looking for ways to increase our accuracy, and one of the ways that we do that is by using indicators. In today's discussion, we're going to talk about different indicators that can be used and their entry requirements for either going long or short based on the read that the indicator is providing us with. So sit back, get tight, and learn a thing or two about a variety of different indicators, and perhaps at the end of all of this, you'll have a little bit more power in your trading arsenal. Let's get going. In the trading world, there are a variety of styles and ways to trade. One of the most common in today's day and age is what we call day trading. This is a form of trading where we're actively buying and selling multiple securities or the same security multiple times within a single trading session. So within a single day. The concept here is we're looking to take advantage of price discrepancies or intraday price swings, and we generally don't want to, as day traders, carry positions overnight. And normally we will, as day traders, prefer more liquid assets, so we don't really risk being locked into a trade that we don't want to be locked into. And it's also known in the world that day traders can be seen trading on pretty much all markets, whether it's forex or futures or stocks. The list goes on and on. But in order to trade successfully, we need to know how to get in and when. And in the beginning of our trading career, one of the ways that we do this is by relying on the reads that indicators can provide us. The reads that the indicators provide us can give us a bit of clarity inside what is actually going on in the market in a way that we actually understand it. And there's a variety of ways that this information can be related to our brains. Now, how it's going to be the most efficient is going to be very subjective on who you are. An indicator that works for your neighbor may not work for you, and vice versa. And it's important to understand this. We don't want to get attached to any one indicator because we saw someone else achieving great success with it. We don't want to determine that that is the only way that we're going to also achieve great success, because that's just not a true statement. But as we move along, let's talk about indicators even that are going to be very common for you to find in the beginning of your trading careers, but also time-tested indicators that many people on a daily basis do actively use to day trade. The Relative Strength Index, otherwise known as the RSI, will be the first that we cover. We have a picture of it here on this chart. It is an indicator that is going to be listed below your candlesticks or below whatever charts that you have displaying, whether it's bar charts or what have you, line graph, doesn't matter. It's not going to overlay price. Instead, it will be listed below it. And on the right-hand side, you'll see a column of numbers. These numbers represent an idea that the market may be overbought or it may be oversold. On the left-hand side here, we can see very simple entry requirements to either go long or to go short. If we sell when the indicator climbs above 70 and falls back below it, which occurred over here on the chart, this would have resulted in a very nice downturn in the market, and we would have caught it in time. If we buy when the indicator falls below 30 and rises back above it, essentially just completely inversing those rules, which occurred over here on the chart, then we would have also seen a very nice outcome for our position. The RSI is very simple to use. We are paying attention to how this line is oscillating between the 70 mark and the 30 mark. The idea is that when the market is going to be at or above 70, we are possibly witnessing an overbought scenario, especially when that line comes back below the 70 mark. On the other hand, when the market is at or below the 30 mark, we're considering the market to be a bit oversold, especially when it comes back above that 30 mark. And these can provide us good value opportunities potentially to get into the market. Next up, we have the moving average convergence divergence, which we'll just more aptly refer to as the MACD. The MACD really is the ultimate moving average indicator, as it's constructed by subtracting a 26-period EMA from a 12-period EMA. The MACD is the main slower line, while the faster line is going to be the signal line. When we say slower and faster, just to clarify, that's generally going to refer to the lower number setting. So a 12-period line is going to respond faster than a 26-period line. So the MACD is really an example of a lagging momentum indicator that day traders often use to plan their next moves. By looking at the lines of the MACD, day traders can timely spot crossovers, convergences, and divergences, all of which we're going to cover, so don't panic. They're very easy to identify as well, kind of like the RSI, but perhaps one step further. A crossover is going to happen when the MACD lines cross, as we can witness here and here. We're witnessing the lines cross over themselves, but there's another cross that can happen, or way we can refer to something crossing, and that's when these lines cross above or below the 0 mark, which is going to be more easily viewable if you apply this indicator to your own charts, because these numbers are probably quite small at the time that you're watching this video, but they will be listed in the column on the right. All of this provides us information. So the 0 line, center line crossover happens when these MACD lines move above or below it. That's all we really need to understand about that. But if the MACD crosses above the 0 line and becomes positive, that would then be considered a bullish crossover. If it crosses below the 0 line and becomes negative, we then have a bearish crossover. So the concept here is by paying attention to the orientation of these lines and their position with the 0 line, we can justify buys or sells, or longs or shorts. So down here, we witnessed our MACD line cross over our signal line, and what happened is we got ourselves a buy opportunity, which would have been met with a nice bullish run in the market. Then the opposite happened, and we could have been met with a nice signal to sell if we jumped in and the market did downturn after this point. In this scenario, we can see how falling below the 0 line, as we just referred to as a 0 line crossover, in conjunction with a bearish MACD orientation of the lines, can be used to further confirm the lower lows and lower highs that we're witnessing in the market as a viable selling location because of heavy bearish momentum. Down here, we crossed below the 0 line with a proper orientation, or a bearish orientation, of our MACD and signal line. The market was working its way downward at the time as well to further confirm it, so a short at this location would have potentially paid us off. Then, on the opposite side of that coin, if we have our MACD and our signal line in a bullish orientation moving above the 0 line, we now have ourselves an opportunity to look for a buy if the market, the price action itself, was showcasing higher highs and higher lows to further confirm that a buy makes sense to take advantage of bullish momentum. We have yet another way that we can use the MACD to identify signals or justify entering into a long or short position. We refer to this way as the divergence way. This is when we have the market trending one way and the MACD trending another in a very simple term. This is going to be when the market is showcasing lower and lower lows, essentially trending downwards. If you can draw a line on the bottom and it angles downwards, but the MACD, on the other point, is actually trending upwards. The lows are actually getting higher. This is an indication of a market reversal potentially. That's what the MACD is trying to tell us. With this scenario, we would actually expect the market to stop going downward and begin going in the direction of what the MACD is highlighting. highlighting. So if we see the MACD and it is starting to get higher, but the market is still getting lower, we want to be prepared for the market to potentially make an upturn. The opposite is true if the market was getting higher and the MACD was getting lower. In that case, we want to get ready for the market to possibly make a downturn, and that's an opportunity to short. Next up, we have the stochastic oscillator, which is really very similar to if you were to cross the MACD with the RSI. So if you got the first two, then this one should be a very easy grab. On the right-hand side, we have a column of numbers. On the bottom of those numbers, the indicator is going to begin at 0 and it is going to end on the top side at 100. And we'll see these lines oscillate between these two locations. The goal here is to pay attention to when they're above 80 and when they're below 20. Those are the magic numbers for the RSI. When we're above 80, we're going to consider that overbought. When we're below 20, we're going to consider that oversold. So the idea is that when the indicator lines cross from the 80 level back below, we can look for an opportunity to sell the market. Let's look at how that turned out here. So we cross back below, indicator shows it did work with this particular example in the market. And then back again down here, this would be the exact opposite. So this would represent an opportunity for the market to be oversold and we could look for the buy. At this time, when the indicator crossed back above the 20, the market did rally. You are probably getting the idea. If you're wondering what these exact lines are, there is a K line and a D line. This doesn't matter as much, but you need to know that the K line is going to be faster than the D line. So when the market is responding, the purple line in this case is going to be the K line and it is going to respond first. It is your faster line. Another cool thing about the stochastic oscillator is just like the MACD, we can use it to spot divergences, and you're going to do it in the same way that you would be doing it with the MACD. If the market is marking higher highs and higher lows, but the stochastic oscillator is not in agreement with that, generally we want to favor what the stochastic oscillator is telling us. Next up, we have one of my all-time favorites, Bollinger Bands. Now, Bollinger Bands are going to be displayed on top of price. It is not going to split your chart and be displayed below your price graph. Instead, it will overlay it with 3 lines. Depending on the trading software that you're using, it may shade those lines in, it may not, but either way, I like Bollinger Bands because I do feel that they are very clean and they still allow you to view what's going on behind the scenes, behind the indicator, as we'll say. The concept with Bollinger Bands is the indicator is giving us a range within which the asset that we're looking at's price is typically trading. So based on the recent volatility, the width of the bands increases and decreases. The wider the bands are, the larger the volatility, and vice versa. If the bands are close to each other, then the volatility is low. So for example, if we look at this portion of the chart over here, this perhaps could have been, say, at lunchtime. Lunchtime behavior will look more like this. When we get out of lunchtime or before lunchtime, the market might look more like this, where it is more volatile, the bands are wider, and price is going to be a bit more playful with the location of those bands. Now, there are 2 ways we can find decisions to long or short based on Bollinger Bands. The first is by using those outside bands as areas of potential support or resistance. Generally speaking, price is going to remain inside those outside bands. So by that theory, we would be expecting a long or short. So a long if we are outside the bottom of the bands to favor the price going back into the bands, because the majority of the time it will be. And when I say the majority of the time, we're talking well over 80% of the time, depending on if, once again, you monkey around with your settings. But that's going to be it on default settings. So if we were at the top end of the bands or outside the top end of the bands in a range-bound market, this could be a very good location to look for a short position, because once again, we're treating these tightened bands almost like an area of support and resistance, even though it's dynamic and it is moving. Now, once the bands open up, as we see on the right-hand side of things, the price being outside the bottom of the bands can be an indication of heavy bearish momentum, especially if it has just broken through an area of support. So the read that we were just talking about more or less gets completely inversed. When price is traveling heavily in a direction. At that point, being outside of the bands after something substantial has happened, like breaking an area of support, we can use that to further justify the momentum and strength in the market and look to go in that direction. So it is different in a range-bound scenario than it is in a momentum-bound scenario. When the market is directionally heading in either up or down, this applies the same. If hypothetically the market was traveling upwards and it was riding the top of the bands and the bands have expanded and we just broke out through an area of resistance, we could use that as justification to look for a long. So one of the cool things about the Bollinger Bands is it's really good for any type of market behavior once you begin to get good at identifying which type of scenario you are in. Are you in a range-bound market or are you in a trending market? So yes, there are a variety of ways that you can use indicators to identify whether you should be going long or short if you are day trading or really any type of trading for that matter. The indicators that we covered are a great place to begin, especially if you are a new trader, but do not forsake them even if you are a veteran. If you haven't used them, I strongly advise checking them out. You can always practice on a demo account. Demo accounts are a godsend. Please make use of them. But until next time, good luck out there. Happy trading. I'll see you all very soon.